Nigeria's 2025 tax reform led to the enactment of 4 laws, which include Nigeria Tax Act 2025. This act repeals certain existing tax laws and consolidates tax provisions into a single document to eliminate conflicting provisions. An individual's total income for any assessment year is their taxable income less total deductions comprising ascertained losses, capital allowances, tax-exempt income, and income subject to final withholding tax under the Nigeria Tax Administration Act. Chargeable gains are computed by deducting the asset residue or acquisition cost from disposal proceeds, less incidental disposal costs, where only part of an asset is disposed of. The acquisition cost or residue is apportioned using the fraction A divided by A plus B, where A is the disposal consideration and B is the market value of undisposed portion. Gains on tangible, movable personal charters are exempt if the disposal consideration does not exceed 5 million or 3 times the minimum wage, and motor vehicles used solely for private or non-profit purposes are not chargeable assets, limited to 2 per year. Furthermore, property held in trust for public charitable institutions, registered friendly societies, cooperatives, or trade union is exempt from this part, provided the gain is not derived from disposing of an asset acquired in connection with trade. The taxable income of an individual shall be taxed at a progressive rate, ranging from 0% on the first 800,000 to 25% on income exceeding 50 million after the eligible deductions. For each assessment year, a small company with gross turnover of 50 million or less and fixed assets not exceeding 250 million, excluding professional services, is taxed at 0%, while any other company is levied at 30% of its total profit from the commencement of this act. A 4% development levy is imposed on the assessable profits of all chargeable companies, excluding small companies, non-resident companies, and profits computed from hydrocarbon tax to be collected by the service into a designated account. The accrued revenue shall be distributed specifically. The profits of an export processing zone entity are exempt from tax if solely derived from export-related sales, or if sales to the Nigerian customs territory do not exceed 25% of total sales, but such profit shall become fully taxable from January 1, 2028 or a later date not exceeding 10 years from the Act's commencement, as ordered by the President in respect of sales to the Nigerian customs territory, regardless of the percentage. A royalty is imposed on minerals with the ad valorem value determined by the official selling price set by the Federal Ministry of Solid Minerals or ruling international market prices. Petroleum profit tax computations shall be made in US dollars, while crude oil is allocated as royalty oil to the Commission or order for royalties and rentals, cost oil to the contractor for US dollar, operating cost recovery, tax oil to the Commission or order for tax liabilities, and the remaining profit oil to the parties in accordance with the production sharing contract. Taxes paid outside Nigeria on foreign-derived income or profits of a Nigerian resident are allowed as a credit against the corresponding Nigerian tax liability, provided the foreign tax and income arise under an agreement with a treaty partner, subject to the advice of the Nigerian Postal Service and additional modes prescribed by the Joint Revenue Board via regulation. Duties on instruments shall be denoted by tax stamps, dies, electronic tax receipts or certificates, with the stamping obligation falling on the transferee or beneficiary within 30 days of execution. A 5% surcharge computed on the retail price is imposed on chargeable fossil fuel products provided or produced in Nigeria, collected monthly by the service upon the earliest of supply, sale, or payment effective from a date gazetted by the minister, while explicitly exempting household kerosene, cooking gas, CNG, and renewable energy sources. The 10th schedule lists priority sectors eligible for economic development tax incentives for specified periods, subject to presidential amendment based on public interest criteria, while applications are made to the NIPC Executive Secretary, provided qualifying capital expenditure meets the specified threshold. The following instruments are exempt from stamp duties under Chapter 8. Government or legislative stock transfers, ship or vessel dispositions including mortgages, instruments where duty is payable by a Nigerian government entity or a foreign consular officer subject to reciprocity, instruments by registered cooperative societies, securities transferred or returned in regulated securities lending transactions, all stock or share transfer documents, and electronic money transfers or receipts below 10,000, including salary and intrabank self transfers, subject to conditions. Profits from public character institutions, registered friendly or cooperative societies, trade unions not derived from trade, as well as government bodies, authorized collective investment schemes, and qualifying real estate investment companies distributing at least 75% of income are exempt from income tax. Similarly exempt are certain compensating payments in securities lending, consular fees, excluding trade or resident non-nationals, diplomatic income and pension assets or benefits under the Pension Reform Act. VAT shall be paid on all taxable supplies in Nigeria. VAT exemptions apply to oil and gas exports, humanitarian and diplomatic supplies, baby products, locally manufactured sanitary and military items, shared transport, agricultural equipment, land, money, and assistive devices, whereas 0% rate applies to basic food, medical goods and services, educational materials and tuition, agricultural inputs, and the electricity supply chain, non-oil exports, and electric vehicles, subject to potential presidential exceptions for developmental financing projects. Subject to the Constitution, the Act shall take precedence over any other law with regards to the imposition of tax.